Hello, everyone. Welcome to the Basics of Economics, Inflation. I've heard some feedback that the previous workshops were quite complex, and people would have liked a couple of videos that just go into the basics, into a bit more detail, so people can get a grasp on that, and then they can follow these workshops. So what I'm going to do is I'm going to start a series where I'm just going to explain some basic terms of economics and then explain how they work. So in this video, I'm going to talk about inflation. So I'm going to discuss firstly, what is inflation? Then I'm going to talk about the causes of inflation. Then I'm going to talk about how you can manage inflation. And lastly, I'm going to talk a bit about, related concepts such as hyperinflation and deflation. Now, what exactly is inflation? Let's just look at the Wikipedia definition. It states that it is a general increase in the prices of goods and services in an economy. So basically, it just means that it becomes more expensive to buy something. So with $100, I might be able to buy 100 pairs right now, but I might only be able to buy 50 pairs next year. It just means that the price of the individual pair has gone up, and therefore I can buy less with my money. An alternative way of thinking about this is that inflation depicts the rate at which purchase power of your currency increases. Again, from $100, I'm able to buy less pairs next year. So therefore, the power of my currency, the dollar, has decreased. Now, if you have high inflation, that means that the prices go up very quickly. So let's say I'll be able to buy now 100 pairs. If you have a very high inflation, it would mean that next year I'll be only able to afford 50 pairs. If you have low inflation, it doesn't mean that the prices don't go up. It just means that the amount at which the prices go up is just low. So instead of, being able to afford 100 pairs next year, I'll be able to afford 80 pairs next year with $100. Now let's talk about the context of inflation, because countries want to set a stable 2% inflation rate as a goal for the economic policy. Why is it overall good to have this inflation? So at the moment, it is more expensive for you to buy stuff in the future. It means that people are going to buy stuff now. It is more expensive for them to leave the money in the bank or to, keep it with, on cash with themselves. It is easier for them to actually spend it and then get more stuff than, spend it later on, because later on it will be more expensive. Now, why is it good for people to spend money right now in the economy? So at the moment, you buy things, a company makes profit of that. That profit then gets invested into expanding their business, hiring more people, or they're going to do more research or going to try to make their products cheaper. Now, at the moment they expand their business, it means that other people are hired who then again have now wages which they can spend in the economy. Again, other companies can also profit from this because they also now sell more products, they also make more profit, etc., etc. So this cycle continues. At the moment that you just have them investing this money into research, you get better products that you didn't have access to before. So this can look like new tech, or the products might just become cheaper, which means more people can afford them, which is good because now, for example, people who have a lower income can afford similar things to people with a higher income, which tend to be of a higher quality. So that is why it's overall good to have this inflation, because it creates economic growth. Now, why do you want this growth to be stable? I think this is quite intuitive. So firstly, at the moment that it is stable, people just know what they can expect. So companies know how much it will cost for them to buy a specific resource, or how much it will cost for them to, buy oil so they can transport all the goods. But also, people just know how much they're going to spend on groceries next year, so therefore they're able to budget better. It also means that at the moment that suddenly you have very high inflation. If that is the case, then you go very quickly through your reserves. So if you only have $200 in reserves and suddenly inflation goes up very high, it is very easy to quickly go through those $200. So it just means that if people have built up a buffer, then that buffer is very quickly used at the moment you have high inflation, which is why it's overall good to just have this stable, relatively low inflation rate. Now, what is the cause of inflation? So in general, let's go back. The price of the product is based on the equilibrium between demand and supply. And at the moment that you want to analyze what the price does, you basically look at what happens at the demand side and what happens at the supply side. So if you look at this specific graph, then what you see is you have two lines. You have the demand line and you have the supply line. Now, overall, what this means is if you look at the red line, it's the demand line. It basically states how much demand there will be if you only have this amount of quantity. What kind of price would people be willing to give? Now, if you have the supply side, it basically is the opposite, which is at the moment, you have these prices. How much would a company or someone else be willing to supply that for you? So if the price is very low, then very clearly companies want to give very little of that because they make very little profit. If the prices are very high, they want to spend that. They want to sell as much as they can because they can make a large profit. The same happens for the demand side. If there's just very low quantity, then people are often willing to buy more for it because there's just a scarcity. So this kind of like already gets into a bit of an explanation of how the price works. Because let's say you have a higher demand for products. That means that for each quantity, the amount that people are willing to pay for it goes up. So this whole line goes vertically up, which means that this equilibrium point now is not here, but rather it is somewhere here. So the line for demand goes up, and therefore it meets at a higher point, and therefore the price goes up. Now, something similar happens for the supply. At the moment, you have a lower supply. This means that the line for supply moves to the left. That means that the price, if you look at this way, then the price also goes up because it moves horizontally towards the left, and therefore the price point becomes higher. So overall, at the moment you have a higher demand for products, the prices go up. I think this is very intuitive. Apple phones are very wanted, so people are willing to pay a very high price for them. So clearly, if there's a moment of high demand, people are willing to pay a lot for it to get the iPhone, and therefore prices go up. If the supply is also low, then it also is very intuitive that the prices go up, because if there are only so many Supreme bags or shirts that exist, then to have one becomes a status symbol, and therefore people want it even more, and therefore they're willing to pay more for it because it's more difficult to get it somewhere else. Now, how do you then basically get a higher demand? I think there are a couple of ways to do this. Firstly, at the moment, the government prints more money, or more specifically, maybe the central bank prints more money. Then that means there's more money in the economy. Even if the government tells no one that they're printing more money and doing it secretly, there just simply exists more money in the economy. That means people have more money. What happens if people have more money? They're going to spend it more. They're going to be able to buy more products, and therefore there's a higher demand for products. This means that the demand goes up, and therefore the price goes up. But also, something similar happens for lowering interest rates. Now, what's an interest rate? At the moment you take out a loan, you need to pay the bank money because they are taking a risk. Now, at the moment, it has a low interest rate. It means it is very cheap for you to get this loan, and therefore it is very easy for you to get the loan and be able to afford it. Therefore, you have, again, more money. You can spend that money in the economy, and therefore you have higher demand for products because you have more money. Now, if you have a lower supply, then that can have a couple of issues or a couple of reasons for why you have that. So this can be a war, which might make it impossible for you to get grain, for example, from Ukraine. But also there might just be general shortages. So it might be that you have run out of oil within your country because just your oil reserves have dried up. At that point, you just don't have the good you need, and that creates shortages. But also you can get things such as epidemics, which means that people are unable to work. And because they're unable to work, you're unable to create goods. And because you're unable to create goods, you have a lack of goods, and therefore the supply side becomes low. Now, how can you then increase and decrease inflation? So I think I already kind of explained this when I explained how inflation can go up and can go down. So you can just print and spend more money as the government, but you can also lower interest rates, which means it is going to be cheaper for people to borrow. But there are also other ways, right? Because at the moment that you're going to have more companies and investors in your country, then they're going to create more jobs. These jobs then increase the amount of people spending stuff in the economy, and therefore it creates more demand for products. Therefore, you can just also create a better place or a better place for companies to invest in, which can be via lower taxes or just having some tax benefits for them to invest more, all of this stuff. So there are also other ways to try to increase inflation besides just interest rates and printing more money. Now, how can you decrease inflation? So at the moment, there's just a high demand. So people just want a lot of stuff. Then you just do the opposite of above. So you don't spend as much money in the economy. So you just, don't have big budgets. You higher interest rate, becomes more expensive for people to buy stuff because loans become more expensive. And therefore, you have less spending. At the moment, you have a supply issue. It doesn't really engage with that, right? So what you need to do is you need to try to resolve the supply issue. So at the moment, you don't have any energy because you don't have any access to gas or oil. You might try to invest in green energy, and therefore you now have other supply of energy, which means that, again, the amount of products that can be created goes up again because you've been able to fix your problem, which was a lack of energy. And then that means that the supply side is fixed, and then you're able to have, you're able to have less inflation because supply catches up with demand. Now, those are the absolute basics. There are also some other terms that people throw around when it comes to inflation. At the moment, you have hyperinflation. It just means that you have inflation, but it's just really high. So this is the Weimar Republic after World War I. This looks like the Zimbabwe dollar, which just increases really, really a lot. And this oftentimes is when you get inflation into like the double or triple digits. So this is like if you have 80% inflation rate, that's really high. That's oftentimes when you have hyperinflation. If you have even just something above 100%, it is most definitely hyperinflation. How this exactly happens is quite dependent on context. There's a workshop that I made about this. It also talks about currencies. So if you want to learn more about it, you can look at it there. You also have deflation. So deflation is the opposite of inflation. It basically means that the purchase power goes up in the future. Therefore, it is good for you to wait and not spend money right now because it is cheaper for you to buy more apples in the future. So instead of buying 100 apples now, you can literally buy 110 apples in the future. This is really, really bad for the economy because at the moment, there's no incentive to spend. You then don't get access to the economic growth that I talked about before. So you have less people investing, less people, putting stuff in the economy. Therefore, it is something that you really want to stop. There's also oftentimes a mistake that some debates make where they try to say, we need to curb inflation or we need to lower inflation. And what they say is we need to have deflation. Technically, you don't want deflation because it's not about decreasing your inflation, but rather it's having the opposite of inflation, where people just don't want to spend money. That's just a small technical note that I just wanted to give you as a tip as a debater. Now, the last term is called stagflation. That became a big thing after COVID because this was one of the possible outcomes of bad policies. Now, what is stagflation? Stagflation is when you have very high inflation and you also have very high unemployment. It becomes more difficult to resolve issues because at the moment you try to curb inflation, what you would normally do is you would lower interest rates because, so you'd higher interest rates because at the moment you have higher interest rates, people spend less in your economy and that stops inflation. But if people spend less in your economy, then less jobs are created. So you create a lot of like even worse unemployment. But the opposite is also true. If you want to, have less unemployment, you want to create big projects. So you want to invest in your economy. But it also becomes, bad at the moment that you have more people spending money in the economy and therefore having, an even higher inflation. So you're kind of like in a double bind where you need to resolve one, but it will make the other one. And that is why it's a very interesting thing because it just puts you in a very difficult situation. This is something that we'll go into a bit more depth in the workshop on crises and central banks. But if you want an even more detailed analysis, I can also make a workshop on this. So if you want to have a video on this, please let me know in the comments. Now, this is the end of the video. For the next video, I'm going to, upload the workshop on central banks and crisis that I made for track 1 for the Dutch competitive platform. I'm going to make a video on the basics of economics, and now it's just going to be about banks. I hope that this was clear. I hope you find it useful. And if you have any questions, then you can put it in the comments. I'll try to answer them. And then see you in the next video. Bye.